Hi everybody and welcome. I'm Mike Werner, and today we're going to be taking a look at the preparation of the statement of cash flows. In this video, we're going to be looking at the preparation of a very basic statement of cash flows. Very basic, just so you get the feel. We're going to use the indirect method, which for operating activities takes net income and then converts net income by adding and subtracting various amounts to arrive at cash flows from operating activities. Then we'll add in investing activities and financing activities near the end. So in order for you to follow the example, you'll need to have access to the data, all of the basic information that we're using to prepare the statement. So now let's move into my office. We'll take a look at my computer, and you'll take a look at the data we're going to use, and then with that data, hopefully you'll be able to print, do a screenshot and print it out for yourself. Once you have that in hand, you'll be able to follow the example a lot better. Okay, so here we are in my office, and this is my computer screen. And you can see the source data that we're going to use to prepare this statement of cash flows. To prepare any statement of cash flows, you basically need three sources of information. First of all, you need an income statement, or at least information from the income statement. So we have an income statement here, ABC Company income statement for the year ended December 31st, 2019. It's got all the info we need: sales, cost of goods sold, gross profit, and then from gross profit, wages, insurance, depreciation are subtracted to get operating income of $5,000. We've got interest expense of $1,000, giving us income before tax of $4,000, and then income tax expense is $840. Net income is $3,160. And when we prepare our statement using the indirect method, this net income figure is going to be sort of the star of the show. I mean, we're going to start with that number and convert it to cash flow from operating activities. Some other information that we have here that we're going to need is a balance sheet. Now, I did not present the entire balance sheet, but in order to prepare the statement of cash flows, you do need comparative balance sheets. That is, a balance sheet for the beginning of the period, which is 12/31/2018, and a balance sheet for the end of the period, which is December 31st, 2019. So we have those two, and since this is such a very basic statement of cash flows, instead of complicating the situation with a whole balance sheet, I just picked up the amounts that we're going to need to do our simple example statement. So you need comparative balance sheets, and we have sort of a rendered down version of the comparative balance sheet for the example. The other thing you're going to need is other information. Other information about transactions, such as the purchase of land for cash. This company purchased land for cash, which as you probably already know, or should already know, that's an investing activity. Purchase of a delivery truck for cash, another investing activity. And then for outside financing, they borrowed from ABC Bank, a financing activity, and they sold some of their common stock for cash, which is also an outside financing activity. So this is the information that we're going to need. One more thing I might add is for the comparative balance sheets, you notice that we supply the balance, say in accounts receivable, the beginning balance and the ending balance. And I've also calculated the increase. It's an increase in accounts receivable of $3,000. Generally speaking, these changes, the increases and decreases, are not supplied, and you have to calculate them. But just to move things along a little faster, I went ahead and calculated them for the example. So here with inventory, it's got a beginning balance of $5,000, an ending balance of $10,000. So it's a $5,000 decrease in inventory. Same with accounts payable. It's got a beginning balance of $8,000, an ending balance of $14,000. So there's $6,000 increase in accounts payable. So those amounts are going to be helpful when we prepare the statement. And if you're working on a statement of cash flows and those increases and decreases have not been calculated, you're going to have to go ahead and do the math. And it's very simple to do, but you're going to have to calculate those amounts. So with that, I think you can see this is the information we'll need. I would highly recommend that you do a screenshot of this and print it out so that you can have it in hand as we go through the example. And that way it'll make following along all that much easier. So let's get on back out to the whiteboard and finish up this example. Well, welcome back. We're back here ready to prepare the statement. Hopefully you've got the data in your hand, all the schedules and so forth, the income statement, the numbers from the balance sheet, and the selected other information that we'll need. So I've already headed up the statement. ABC Company Inc. Statement of Cash Flows for the year ended December 31st, 2019. Any document that you prepare, whether it's for accounting or for personal use, it's a good idea to go ahead and head it up so that you know what it is. Most of the time, it's a good idea to use these 3 lines: name of the entity, name of the statement or schedule, and then the date or time period to which it pertains. So we've already done that, so now let's go ahead and start the statement. We're going to start with operating activities. So let's see, we're going to start with cash flows from operating activities. I'm going to abbreviate activities a little bit because, I don't have that much space. And so there we go. Cash flows from operating activities. Let me make it a little bit neater. Sorry about my writing. It is so bad. I wish I was blessed with, better penmanship, but that's not me. Anyhow, the next thing we're going to do is to begin the operating activities section with net income. So we're going to be using 2 columns here, one way over here and another one indented a little bit with some detailed information. So we're going to indent here just a little bit because this is part of the operating activities section. So I'm going to put net income here. And as you recall from the information that we showed just a couple of minutes ago in the office, it's $3,160 is the net income, $3,160. So there we go. The next thing I've got to do is to convert this net income to cash flows from operating activities. And it's a little bit easier said than done. To do this, we're going to take 3 steps. Number 1, we're going to remove the impact of all non-cash revenues and expenses. Number 2, we're going to remove the impact of any gains and losses on the sale of investments. And number 3, we're going to factor in the increases and decreases in the operating balance sheet accounts. So in order to arrive at cash flows from operating activities, we got to take our net income, which is not cash flow, and adjust it. In step 1, we're going to be backing out the impact of all the non-cash revenues and expenses, gains and losses. This would include depreciation in almost every financial statement. So depreciation is a non-cash expense. If you recall, when you make an entry for depreciation, you debit depreciation expense and then you credit accumulated depreciation. You don't take the entry to cash, you see, so it's a non-cash expense. There are others like amortization of intangible assets, very similar to depreciation, and then there's some that are more advanced than what we would get into in this example, things like compensation expense associated with employee stock options, things of that nature. So if we had any of that, we'd be backing out the impact. Luckily for this simple example, we don't have any of that. So now let's take a look. What do we have here? Oh yeah, depreciation is $2,000. So we're going to subtract out the depreciation. So depreciation expense, abbreviating expense. Now I say we're going to subtract it. We're actually going to back it out. When calculating net income, depreciation was subtracted to reduce the amount of net income. So what we need to do is to remove its impact, which means we've got to add it back in. So we're going to, in this detailed column, we're going to put 2,000 here, 2,000 for the depreciation, and we are going to add that back in. I'm just going to put a plus sign there to remind us that's what we're doing. We look for more non-cash revenues and expenses. I've got my sheet here, and there are no more. Okay, so that's it. The next thing we would back out would be any gains and losses on the sale of property, plant, and equipment, things of that nature. And in our example, it's so basic, I'm looking at it, we don't have any of those. We don't have any of those. But if we did, we would back them out of the in the calculations. We'd back it out of the net income. So let's go ahead and move on to the next thing, since we don't have any gains and losses to subtract. The next thing we're going to do is factor in the impact of any operating balance sheet accounts. And we've only got a couple here. If you look at the little table that you printed out, I hope, you'll see the first account on the balance sheet that we're listing anyway is cash. It decreased by $2,000, but cash is like the final answer, so we're not going to be using that in this section. Okay, that's almost like our check figure. We'll be able to tell if we did this correctly or not by arriving back at that number. The next one is accounts receivable. Aha! It says accounts receivable went from $9,000 to $12,000, so we had an increase of $3,000. So what I'm going to put here is we have an increase in accounts receivable. Abbreviating. And the amount is, let's see, it's $3,000. $3,000. Let me get that. Oh, God. $3,000. Now, the question is, did this increase or decrease cash? I mean, that's the big question. And this accounts receivable, just sort of making a note over here, accounts receivable is an asset that increased. The asset increased. Now, when an asset increases, a way to think of it is if your assets increase, just pretend that the increase in the asset came because you bought an asset for cash. So if an asset goes up, if assets increase, that means that cash goes down. So if we say, if inventory increases, it's like we bought the inventory for cash. At least that's what we should think. You know, that's the logic we should use here to help us through this problem. So in this case, the asset increased, and that means that cash decreased. So an increase in accounts receivable decreases cash. So let's put brackets around that to show that that cash decreases. The next is inventory. Inventory went from $15,000 down to $10,000. So they've sold off inventory. It's a decrease of $5,000. So we've got a decrease in inventory. Decrease in inventory. And so that decrease in inventory, let's see, it's $5,000. And this time, we've got an asset which is decreasing. It's decreasing. A little minus sign there, it's decreasing. When an asset decreases, at least when you're doing this type, when you're figuring out what to do with these changes in the operating balance sheet accounts, the way to think of it is the offset is cash. So if assets go down, it's like you sold them for what? Cash. So that means that cash would increase. Cash would increase. Cash would increase. Okay? So, let me go ahead and put a little plus sign here to remind myself that it's an increase to cash. The next thing we've got is accounts payable. And we've got an increase in accounts payable. It went from $8,000 to $14,000. It increased by $6,000. So let me put the number here, $6,000. And just some little side thoughts here, some side thoughts on this. We've got a liability that increased. It increased. Well, the way to think of this is when your liabilities increased, imagine it increased because you borrowed money. You owe more because you borrowed money, say, okay? Now, if liabilities decrease, the thought is you pay them off with cash. So if a liability increases, cash will also increase. It's also going to increase. And just as a notation, if a liability decreases, cash is going to change in the same direction. It's going to be like we paid it off with cash. So cash is going to decrease as well. Will decrease. So what we see here is that when an asset changes, if an asset increases, cash decreases. And on the other hand, if an asset decreases, cash is going to increase. So whatever happens to the asset, the opposite happens to cash. On the other hand, with liabilities, if a liability increases, the change in cash, it's almost like you borrowed the money. So the change in cash is going to be in the same direction. On the other hand, if the liability decreases, it's like you paid it off with cash. So again, the change is going to be in the same direction. So once you follow this, it's pretty easy to do the statement. Once you know these rules. Now, the reason I wanted to show this added note about the liabilities is because, we don't have, wages payable or something like this, where we had an increase in the liability in this example, because it is such a very basic example. The next thing we would factor in here is we would remove the impact of any gains or losses on the sale of, say, property, plant, and equipment. We don't have any of that, but if we did, we would back out their impact just like we would have, just like we did with this depreciation. Next thing we're going to do is add these up. So let's add these three. And when I add them, if you don't mind, I'm going to get rid of these lines here now. They were just temporarily there. I'm going to add them up, and I'm going to put the amount right next to the $6,000. So adding them up, it's a total of $10,000. 10,000. There we go. And now I'm going to combine this 10,000 with our net income. So I'm going to put another line here. And this will, and once I add it together, this is a positive, this is a positive number. So we have 13,160, and that is the cash flows from investing activities. So cash flow from, I said investing, from operating activities. I'm just going to abbreviate both of those words because I'm really out of space on this tiny little board here. And so the increase in cash from operating activities is $13,160. Remember, the net income was only $3,160. How can this be? Very simple. Listen, they've been selling off their inventory. Their inventory's down by $5,000. And what's more, what accounts payable? They haven't been paying their accounts payable properly. Their accounts payable is climbing. So where are they getting their cash? They're not getting it from sales so much as they are, selling off inventory, not replenishing their inventory perhaps, and not paying accounts payable. It's not necessarily a good trend for this company, is it? So let's go ahead and go to the next phase of this, which is, this is the hardest part, okay? Now let's do cash flows from investing activities. So let me head it up here, cash flows from investing activities. In this problem is so simple that all the transactions that involve the investing activities and financing activities have been provided in the example. We don't have to go back and do account analyses and things of this nature to get the amounts. In real life, a lot of times you do get the information like this, but occasionally you'll have to look into the accounts and see, and back into some of the missing numbers. In this case, we don't have to worry about it. So we look at the other information. And if you look at it at the bottom of your printout, it'll say purchase land for cash. What's that? An investing activity. And since we're purchasing the land, it's an outflow of cash. Then we've got purchase delivery truck for cash. Another outflow of cash, another investing activity. Then we've got borrowed from ABC Bank. This is outside financing. This would be a financing activity, not investing. And then sold common stock, and it doesn't say it, but we sold the common stock for cash. So this would be, sold common stock would be an inflow, the way we're financing our business. It would be, again, financing activities. So let me go ahead and begin by listing the investing activities that I just mentioned. So the first one is purchase of land. Okay, purchase of land. And that's a purchase of land of $25,000. So I'm going to put that here, $25,000 in the detailed column. And when you buy land, you're going to have to pay for it with cash, I guess. So let's go ahead and show that this is a cash outflow with the brackets. Next, we have the purchase of delivery truck. And the purchase of the delivery truck was $5,160. So $5,160, and we purchased it for cash. So of course, that would also be a cash outflow. And that's the only two investing activities we've got. So let's go ahead and put a line here to indicate some math is going to happen. We'll combine those two amounts, and we've got what we'll arrive at is the cash flow from investing activities. Cash flow from INVACT, abbreviating a bit here, and that's $30,160 in brackets to show that it is an outflow. The next thing we want to do is our cash flow from financing activities. Cash flows from financing activities, abbreviating a little bit here. And let's see, what do we have? We've got the borrowing from the bank, so I'm going to say bank borrowing. If you were working ahead, doing this on your own, you might have said borrowing from ABC Bank. That's fine. That's fine too, either way. And let's see, we borrowed $10,000, $10,000. And when we borrow money, of course we get money, so that's a cash inflow. And then we've got the next one is sold common stock for cash. Sold common stock for cash. So here we go, sold common stock for $5,000. And turns out those are the only two financing activities. So I'm going to indicate this is cash coming in. Let me draw a line to indicate we're going to add these up. We're going to combine them. And this will give us our cash flow from financing activities. FIN period ACT period, because of the space restrictions here. And so we've got a total of $15,000. $15,000, let me write that a little bit better. $15,000. That's not much better, but anyway. So there we go. And the next thing to do is to go ahead and get the increase or decrease in cash. So what we're going to do is we're going to add up these three items, these three right here. This one, and this one. Add those three together, add the cash flows from each of our different activities, and that will give us the increase or decrease. And if it's a decrease, we'll put brackets around it. So I want to put brackets around this word. Increase or decrease in cash. And so we combine these. Let me put a line here to show we're adding them up. And I invite you to go ahead and add these three together. Whenever we're working through a problem like this, it really is helpful if you instead of just watching the video, you're calculating along, you're writing things down, so you're a more active learner. It helps you remember things a lot better. So the 13,000 to 30,000, 15,000 together, combined, it is outflow. Yeah, I think it's $2,000 cash outflow. And now what we want to do is add in the beginning balance in cash. So I'm going to say beginning cash balance and looking at our information, and hopefully it's on the handout that you have. The beginning cash balance is, where is it? $3,000. $3,000. And so combine that with the cash decrease in cash, we will get our ending cash balance, which is $1,000. Wow, we're down to $1,000 in cash. That's pretty low. That's pretty low, and it is a good thing they were selling off inventory and not paying their accounts payable, isn't it? I mean, otherwise they'd be out of cash. They did buy a couple of assets here, which is good. But man, they've gone through the cash here. So now let's go ahead and, it looks fine, except it would be better if we added some things to make it look more like an accounting person did this. So what we're going to do is put a $sign at the top of each column, $sign here, and a $sign here to indicate that these are dollars. Down here, a $sign for a final answer. And then, as accountants do at the end of their schedules, we're going to put in a double underscore here to let everybody know this is the end of the document. Now, double underlines are, accountants do it, and you say, oh wow, I want to be like an accountant. Let me put a couple here and here. Those are important. No, don't do that. Don't do that. Just because accountants do it, they don't put them everywhere. They don't decorate up the whole page with them. It's only at the end, at the very end, under the final answer. So they are double underlines, not double overlines. So double underlines, and they go near our final answer. Another couple of things here, just to make it look a little better formatting-wise, is under each one of the headings, see cash flows from operating activities, I indented each of the items that appear in the category, and then for the total, I indented still a little bit more. See, indent, indent, and then for the total, indent even more. Indent, indent, indent a little more for the total. And it makes it easier to read and follow. Now let me get rid of all these little marks I made. There we go. So this is the final schedule. Now I'm going to go ahead back to the computer and put up on the screen another version of this, which is on the computer, maybe a little easier to read. So you can take another screenshot of this, perhaps, maybe a screenshot of the one that I show you in a few minutes. So here's the completed statement of cash flows. On the computer, it's a little easier to read. My handwriting is certainly pretty bad, so I figured let me go ahead and show you this thing on a computer so you get a better feel for it. You can see we start off with the net income, make the required adjustments to arrive at cash flows from operating activities of $13,160. Then we list the investing activities to total $30,160. Then we total the financing activities, list those and total them up. It's $15,000. And then we combine the $13,000 inflow, $13,160 inflow, $30,160 outflow, and $15,000 inflow to arrive at $2,000 outflow. We then add in the beginning cash balance to arrive at the ending cash balance. So now let's get back out to the whiteboard for a couple of closing remarks, and hey, thanks for tuning in. I would like to thank you all for tuning in today. I hope you learned something from this video. If you did, please give it a thumbs up. And until next time, this is Mike Warner saying bye from Miami.